Hi, I'm Philip Smith, financial planner with Tidepool Wealth Strategies, helping self-employed professionals and solopreneurs just like you cultivate resilience in your plans to retire well. This is the Financial Planning Podcast about money management, best practices for long-term growth, wealth-building truths and fallacies, successful retirement strategies, and more, where I'll be sharing concise, actionable retirement planning guidance. Welcome to the Financial Flow. Welcome to episode 17 of the Financial Flow. I'm Philip, and last week I touched on some risk mitigation topics for the self-employed to be attentive to. Today, we're wading a little deeper into the tide pool of financial knowledge to take a closer look at how smart tax planning can be a powerful tool in your risk mitigation strategy as a solopreneur. Before we dive in, if you find today's episode helpful, please share it with your network, give it a thumbs up, and subscribe to continue receiving the flow of content. Oh, and any sources for this content are listed at the end of my transcript, which serves as my show notes. Let's start with why tax planning is more than just a necessary evil. It's a strategic pillar in your overall financial plan. As a solopreneur, you're not just wearing multiple hats, you're also shouldering the entire financial risk of your business. Missteps in tax planning can lead to costly penalties, missed opportunities for savings, and ultimately, a hit to your financial resilience. Tax planning isn't just about minimizing what you owe. It's about strategically timing and structuring your financial decisions to protect your wealth. And that's the key, protection. By taking a proactive approach to tax planning, you can mitigate risks like unexpected tax bills, cash flow issues, and even potential legal complications. For instance, many solopreneurs overlook the implications of quarterly estimated tax payments. Missing these deadlines can result in penalties that eat into your profits. And personally, I utilize a high-yield savings account for my tax withholdings, making the quarterly estimated payment as a direct deposit the day prior to it being due. In 2024, the IRS penalty for late payment or underpayment is currently 8%. There isn't a CD, money market fund, or high-yield savings account that can beat that. While placing the money intended for tax payment in an account that can yield notable interest does help your money continue to work for you, that IRS penalty cannot be outpaced. Therefore, a late payment or underpayment is a losing proposition in today's interest rate environment. With proper planning, you can manage estimated payments smoothly, keeping your cash flow steady. One of the most effective ways to mitigate tax risks is by fully understanding and utilizing the deductions and credits available to you. For example, for those who legitimately qualify to claim it, the home office deduction can significantly lower your taxable income, but it must be calculated correctly to avoid raising red flags with the IRS. Did you know that approximately 35% of home office deduction claims get flagged for audits? Properly documenting and calculating this deduction is crucial to avoid any unwanted scrutiny. Another area often overlooked is retirement contributions. Contributing to a solo 401k, SEP IRA, or simple IRA not only prepares you for the future, but also offers immediate tax benefits. It's like hitting two birds with one stone, planning for retirement while reducing your current tax liability. Now let's talk about something really exciting: income timing and expense bunching. Two strategies that can help you manage your tax liability more effectively. Income timing involves deferring or accelerating income depending on your tax bracket in a given year. If you anticipate being in a lower tax bracket next year, if possible in your business, you might defer income until then to reduce your current year's tax burden. Expense bunching, on the other hand, involves grouping deductible expenses into a single tax year to exceed the standard deduction and maximize your itemized deductions. For example, if you know that you'll have significant medical expenses next year, exceeding 7.5% of your adjusted gross income enables you to itemize these. Consider timing other deductible expenses like charitable contributions in the same year to take full advantage. Next, let's briefly touch on proper entity structure because the structure of your business entity also plays a critical role in tax risk mitigation. Whether you operate as a sole proprietorship, LLC, or S Corp, each structure comes with different tax implications. For example, electing the S Corp status can help you save on self-employment taxes by allowing you to pay yourself a reasonable salary and take the rest as a distribution, or sometimes called an owner's distribution. However, this strategy must be implemented correctly to avoid drawing IRS scrutiny, And there can be trade-offs to consider, like the potential for reduced payroll taxes, which can in turn reduce your future Social Security benefit. Let me take a moment to emphasize the importance of professional guidance, and that while we're moving a little deeper into the topic of tax strategies, it's crucial to remember that I am not a tax professional. My goal is to give you a solid understanding of these concepts, but when it comes to implementation, consulting with a tax advisor is essential. They can help you navigate the complexities of the tax code, ensuring that your strategies are both effective and compliant. In fact, a 2023 study by the National Association of Tax Professionals found that small business owners who work with tax professionals are 25% less likely to face IRS audits than those who go it alone. That's a significant risk reduction simply by having the right expert on your team. Okay, now I'll share a quick example to highlight the importance of proactive tax planning. In 2023, there was a freelance graphic designer who neglected to make quarterly estimated tax payments. She found herself facing a hefty tax bill and penalties at year end. By the time she realized the oversight, she had to liquidate a significant portion of her emergency fund to cover the unexpected expenses. This situation could have been avoided with proper tax planning and guidance, underscoring the importance of staying ahead of your tax obligations. And I think for today, that's probably enough information. So let's take some action on this. This week, take the time to review your tax planning strategies. 1, evaluate your deductions and credits. Are you maximizing all the opportunities available to you? If you don't work closely with an accountant, you may be missing valuable tax savings. 2, consult with a tax professional. That's that accountant I referred to. If you don't already have one, now is the time to find someone who can help you navigate these complexities. Even the most intelligent business owners need a team of professionals, and the most successful business owners, regardless of intelligence, are great at leveraging the wisdom of tax, financial, and legal professionals. 3, review your business structure. Is your current entity type serving you well from a tax perspective? If you're unsure, start the conversation with a CPA. Taking these steps will help ensure that your tax planning is not only effective, but also a robust part of your overall risk mitigation strategy. Thanks for tuning into this episode of The Financial Flow, brought to you by Tidepool Wealth Strategies. Until next time, stay resilient and plan to retire well. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon, 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity. Whew.